in the fora. By the way, I like the fact that in the forum there was quite an active dialogue, and what I really enjoyed is that you were trying to help each other. Sometimes there were questions from course participants that other participants try to answer, and that's quite a nice dialogue. We'd like to see that. So I've noted here the questions as they came up. The first question that someone posted was, how do we determine the inflation rate in a project over the project years? You will have seen that when you try to estimate the cash flows that a project is going to generate, you also try to factor in the inflation, the rate that costs can go up or that revenues can go up. And of course, inflation is difficult to predict even for next year, let alone for 15 or 20 years in advance. So it's impossible to estimate that exactly. And on top of that, you may have a general cost inflation for the general costs in a country. But if you're looking at a specific commodity like energy, it may be that there's a different price development in the future for energy than there would be for other elements. So it's impossible to estimate it exactly. I guess who would try to answer the following question? Is inflation good or is inflation bad for a project? Who thinks it's bad? And who thinks it's good? Okay.
It depends on how it goes, isn't it? So if the inflation actually is a negative number or remains at least stable, should be probably something which can be positive. But on the other hand, it could be also bad because the debt that has to be repaid is already determined upfront with some given interests, but the revenues, the cash flows, the inflows might actually reduce because energy is going to cost less, for instance. And so, but I have to give back a lot of money to the lenders, which is already defined in the contract. So this is what I think. Maybe confused, but this is what I think.
Yeah, I think you're flagging the right points. I think normally inflation means an increase in price and deflation means a reduction in price. So under normal circumstances, inflation, a high level of inflation would mean that the costs go up, but the revenues also go up. But your loan does not go up and your cost of the loan does not go up either if you have fixed interest rates. So under normal circumstances, because your revenue would normally be bigger than your costs, you would expect that a positive inflation, a high inflation, would probably generally be good for a project because your revenues go up by more than your costs go up and then your funding rates go up. So under normal circumstances, if there's a high level of inflation, that would create extra cash flows for the project normally. On the other hand, if you're making an assessment on day one whether a project is going to be successful or not, you would not want to overestimate the amount of inflation because then the reverse would be true. If the inflation is lower then and you factored it in, then it may be that your cash flows will disappoint you. So I think we saw in the case, I don't know if you've all had a chance to look at the case study. The case study focuses on a project in a country that has a high level of inflation. At least that's what's been assumed in the case. You will see that that creates some extra room in the project in a financial sense. But obviously no one can predict the inflation rate. The best assessments you probably have is from the National Bureau of Statistics, what the inflation rates have been in the past, and an extrapolation of those rates based on your estimates of what the economic development will be. That's how I would answer that question. Any further questions on that?
I have a question. Ideally, would it be better to have a higher interest rate, inflation rate in the beginning of a project or on a later stage? If you could choose it, of course. That's not what happens in reality.
Yeah, it depends a bit on what the cash flows of the project would be. Let me share a screen with you again. Because not every project has the same profile of cash flows. I've given here, you can see two examples of a project. One is a toll road, which has cash flows that are growing with time because the traffic is growing, the number of people in the country is growing and the traffic is growing. And the other is an example of an oil well, where in an oil well you extract up to a maximum amount of oil, and then after a while the well deteriorates and you have less. So if you had these two projects, I think, Pilar, you were asking this question, where would you want the inflation to be ideally, if you could choose, in this project?
In the middle, where you have
in the middle,
higher,
exactly.
highest revenue.
Yeah, exactly. Of course, it's a theoretical exercise because in practice you obviously don't have a choice. Yeah. Okay, shall we move on to the next question now, which is a question on how do we reasonably estimate the interest rate when we are extending a loan in a project financing? I guess the way I'd answer this question is that we need to break down the rate into three component parts. There is a base rate, a basic interest rate. Then there is a cost compensation for the fact that you make costs when you are a bank or you're a financier. And then there's a risk margin to factor into the fact that the loan may default. There's a risk that the loan will default. And of course, projects are different in the amount of risk that they involve. So they will be different in the amount of the risk margin. So the base rate, you would typically take what they call the swap rate or the IRS rate for the period that the loan is to be extended. So this could be a 10-year or a 15-year or a 20-year period. And you can look up, there are tables with market rates. You can find them on the internet, but banks would probably have their own sources. And that will essentially tell you what the riskless rate for an interest, for an instrument with the term that we are looking to provide. At the moment, as we'll see later on, the actual rates are negative for many. The basic rate is often not positive, but negative because of the huge amounts of money that are being poured into the market by the central banks. On top of that, you would have a cost factor for the fact that you have an organization that needs to earn money. And then on top of that, you have a risk margin, and the risk margin, every bank has its own system on how you estimate the risk. But the way we do that at the Green Fund, where I work, is we take a combination of the securities that you have, the collateral that you receive, and the risk of fluctuation to the cash flows, so that these cash flows here go up or down. So in a toll road, the risk would be very small because the traffic is obviously is reasonably predictable. Although even now with Corona, people are traveling less. So if there's a Corona lockdown and people are locked in their houses, obviously the ticket sales for a toll road would also fall. So you try to estimate the fluctuation, the volatility, as they call it, of the cash flows, and you try to estimate the value of your collateral, and the combination of those two would give you a certain risk perception, and that would determine the the markup. So if you are funding a project to develop a new medicine, obviously the risk profile will be very different to when you are trying to extend a loan to a toll road project, for example. So the risk premium obviously would be vastly different between each of those projects. Is that a fair answer of that question? Because I'm sharing my screen, I can't see. I saw some people stuck up their fingers or raise their hands. I can't see that because I'm sharing my screen. Maybe Patricia, if someone waves their hand, you can let me know.
Yes, I can let you know.
Yeah, fantastic. Thank you. So the next question was, what are the types of loans that are available in a project finance? Why in some financial models they use both long-term and short-term loans? The reason they do that usually is because there is a certain profile that the project is expected to generate. Here we see these graphs again of the toll road, where in this example, we've got cash flows that are increasing year by year, but we've also got the oil well. In this project, there's a great variation in the cash flows. And what we try to do is we try to match the repayment of the loans, and we try to, that's called the debt service. We try to match that as much as possible to the profile of the cash flows, so that every year we have an amount of interest and loan repayment that matches more or less the cash flows that we are expecting in that year. That's called sculpting the debt. It's trying to make the profile of the loans match the cash flows. And sometimes you do that by having, in this case, a loan that is maybe maturing here, halfway through, because you've got good cash flows, you have good repayments that you can make, and you want to make sure that you've got not too heavy loans in these later years, because the cash flows are expected to drop dramatically. So that's why you sometimes see loans that have different maturities as a way to match the loan repayment profile to the cash flow profile. Sometimes you also see loans that have a fixed rate and loans that have a floating rate of interest, one next to the other. You would do that because sometimes you want to be able to pay back a loan early because you've got a lot of cash flows in the beginning. But once you have a fixed loan with a fixed term and a fixed rate of interest, you can't repay that, or you can, but then you have to pay a big penalty on repayment. So by adding a loan with a floating rate, with a variable rate of interest, you build in the flexibility for the project to, if it has extra cash flows coming in, to repay that loan without incurring the penalty for the fixed rate of interest. That's why you would have those two loans side by side, or even more loans side by side. Sometimes you have a loan that is only there to fund the VAT, which is a tax that you pay when you make an investment. But you sometimes get often you get the VAT back very quickly. So you'll have a VAT facility that you can use to pay back the VAT when you get it back from the government very quickly. So that's why you would often see different kinds of loans with different profiles. Essentially, they're there to match the profiles of the cash flows. Is that a clear enough answer for that question?
Yep.
Okay, thank you. So what are the typical sensitivities that the financiers will be looking at in a financial model? So this refers to the explanation I was making in, I think, the section on the financial model, that what you use the model for is to try and predict the future. You're trying to analyze what you think the cash flows are going to be in the future. So here we have, again, let's use this example. So we've got a project that is expending money for 3 years, for 3 periods. It's making a capital cost to build, say, to exploit an oil well. It's then generating income. It's had some operating costs, and then at the end it has a big outflow. Any idea what this could be, this outflow, if it's an oil well?
Decommissioning?
Yeah, exactly. It's the decommissioning. It's to make sure that you bring everything back in the in a clean position. So you need to decommission and take everything away and clear up any pollution that you've caused. So what you try to do with the model is you try to analyze those, but you also try to analyze what if something happens, what is the consequence for my project? We had the example of inflation as an input for the model. You could look at, you could increase or reduce the inflation just to see what that does with your cash flows, whether they go up or down, and whether at a certain level of inflation you would run into difficulties or not. So the question is, what kind of sensitivities would you want to run? What kind of things would you try to look at? And I think in general, you would try to analyze 3 main areas. You would try to analyze the consequences for your revenues. So if you have a power station in the Philippines, as we've looked at in the case study, that depends, of course, on the number of hours that the power station can be operational. It can depend on the efficiency of the operations. It can depend on the price at which you sell your power. So all those elements go into your revenues. And what you would try to do is you would try to analyze what is the implication on my revenue if I need to go through a maintenance schedule after. Here we had, I think we had an example of the toll road, that somewhere mid through we need to make a big investment to make the road roadworthy again. We need to resurface it, for example. In that case, we'll be assuming big costs, but we'll also need to meet. It would probably also mean that we need to close the road. In those years. So we would have a maintenance schedule, and one of the sensitivities we'll be running is what if the maintenance the maintenance costs are above schedule, the production hours are below schedule. So we'll be wriggling those values in the model to see what the implications are for the revenues. And in particular, of course, when we're financing, we'll be looking at what levels will we drop through our minimum debt service cover ratio level? At what stage will we run into a default, and will we run into financial difficulties with the loan? We could do the same kind of analysis with the costs. We're expecting that this project is going to cost us this much money. These are outflows. But what if we have a budget overrun? Because in the end, the building company charges us much more, or there's a problem with the soil stability and we need to put some extra foundations in, or whatever other kinds of things. So we tend to deal with those in Green Fund, where I work, by using contingencies. We just add a certain percentage of contingencies on top of that. And then we look at what the implications of that would be for the cash flows and for the cover ratios in the loan and for the return of the project. And then we can do the same thing for the timing. We may want to factor in a certain slippage of time, because nothing ever goes exactly according to plan. We've seen now with the corona that often building and construction is delayed because labor force is unable to work for a certain period of time. So these are the main areas that we would be playing around with the inputs in the model to see what it would do for your cash flows. And hopefully you'll have had a chance in the case study to play around with those. And we gave you some assignments to to see what that does.
Yeah, in fact, I have a question here, Emily, if that would be, if I am allowed. If you could kindly share, share the other profile.
Sorry. Yeah. I was going to look you in the eye, but I'll go back to sharing the screen. Yeah.
Correct. So now in the calculation of the NPV, what about this red capital, this extra money that is spent in this moment in time? This amount is a negative number. Okay, fine. This has to be somehow discounted to today, more or less.
Correct.
But with the same discount factor of the cash flows, or with a different discount factor?
Same.
Okay.
Same. Yeah. You could even do just the analysis on the net balance between these two. I can't see a reason why you would have a different factor.
Okay. Fine. Just for my understanding. Okay, perfect. Thank you.
Yeah. Any further questions on this? Then I would like to propose we move on to, this was a complicated question, Monte Carlo simulation, where I'm on slippery ground because I'm not a mathematician. So I will tell you what I know about it, but what I know about it is probably less than what many of you know about it. When we did the sensitivity analysis we were just talking about, we're taking one particular element out of the model, and we're increasing or reducing that to see what the implications of that are. But in real life, you don't have either a fall in revenues or a increase in costs or a delay in timing. Obviously, you'll have all sorts of factors that are occurring at different times in different proportions, but also at the same time. And when you have so many moving parts, one of the way that you can analyze the overall implications of that is by applying Monte Carlo simulation, which is a technique, a mathematical technique, where you wriggle all these different factors in their different, each in their different proportions, and you run every scenario time and time again to look at what the combinations of these factors do, and it gives you an overall distribution of outcomes of each and every of these factors. And based on that, you can then assess what the overall profile of the cash flows is likely to be with all these different factors included in there. Now, running a Monte Carlo simulation is not something I can do. I don't think I can be proven wrong. There may be very sophisticated banks and very sophisticated institutions that actually run a Monte Carlo simulation on a systematic basis. I'll be interested in if there's anyone who knows that there is an institution that does run a Monte Carlo simulation. I've not been involved in a project where they've actually done that. They do come into account. For example, when we have a wind project, I saw some people who work on wind projects. In a wind project, you often have what they call wind reports, which are estimates of what the wind profile is likely to be in the location where you're building the turbines. And in wind, you have many different wind directions, wind profiles, and there they do a Monte Carlo simulation of the wind expectations, and they run that in what they call P scenarios, P50, P30, P90. The P means probability, and it essentially says that with a probability of 50%, the wind power will not be below X, or with a probability of 90%, the probability will not be below Y. When we try to assess the expected revenues, the expected cash flows, we always take a conservative assessment. We try to estimate very carefully what the wind production will be. So we would then estimate that the turbines are likely to produce with 90% probability, so with the P90 scenario. That's what all I was able to say about the Monte Carlo simulation. As I said, there's probably mathematicians among you who know a hell of a lot more than I do about this. Any further questions? Okay, if there are none, then I'd like to move on to the next question, which is someone was reminding us that sometimes from an investment point of view, it may be a good strategy to diversify, to spread your bets and not to place all your bets on one and the same horse. So I think that's a sensible strategy, of course. When you're buying a portfolio of shares, you're better off not buying just one share, but you're better off buying a diversified portfolio of shares. So as a general rule, a diversification strategy is a sensible strategy. But then this person was pointing out that what we're saying in the course is that when we are contracting with an EPC contractor for the construction of a project, we try to make one contractor responsible for everything as much as we possibly can. We don't, if we can avoid it, try to have many different contractors, each doing an element of the transaction. So there we're going against the diversification. We're actually it's a concentration. And then we're going one step further. I was also saying in the course that we also like to make that same contractor not only responsible for the construction, for the building the project, but also we'd like him to be responsible for the O&M, the operation and maintenance, which is placing even more eggs in the same basket. So it's even more concentration rather than diversification. They're saying, does that not go against the general rule that you'd want to diversify as much as you can? And of course, the answer is it is going against that. It is doing it differently. I think the reason we're doing it this way is because a diversification strategy works well if you've got different assets that have no implication on each other, and that the combination of the assets in your portfolio doesn't really create extra tension. Here, where we have a project where one contractor is responsible for the soil preparation, one is for the foundation, another is responsible for the building, and a third is responsible for the machines and installations inside it, and a fifth for the air conditioning. If a problem occurs, especially when you have a network of contractors, I think the experiences are that a contractor tries to point the finger at someone else and says, well, I couldn't build my wall because he didn't do the foundation probably. And the foundation guy says, well, I couldn't do that because the soil wasn't prepared properly. And you have a lot of complications in trying to find out what went wrong, who's to blame, who is going to put it right, and who's going to bear the financial consequences of that. And because the experience has been poor with different teams, with teams of different contractors, by the way, it gets even more complicated if each contractor has an insurance company that is also trying to avert the responsibility and the blame to another. So you've got the number of contractors times 2, because they each have an insurer that gets involved. I think the experience is that it's much easier if you make one contractor responsible have the end responsibility for the realization of the project. That doesn't mean that he has to do everything himself. It can still mean that he has a separate contractor for the foundation, or for the walls, and for the installations. Of course, different contractors have different strengths, have different expertise. So you'd probably still have a network of contractors that are working on the project, but you'd probably want to have one contractor to have the end responsibility for sorting it all out. If you don't have that, it would mean that the lenders would, in the end, have the responsibility for sorting that out, because they are the ones that have the financial risk, and they don't have the expertise. The one EPC contractor, who's the main contractor, has much more expertise for sorting it out than the financiers would have. So that's why I think we would go against a complete diversification strategy. Is that clear enough?
Yep.
It is, Emil. Yes.
Thank you. Someone was making a more general economic point that we now have a situation in the markets where interest rates are really, really low. Who knows, by the way, why that is? Why are interest rates so low now?
To foster more economic development?
Yeah, economic growth. It's essentially money. The main reason is that governments and central banks, well, mainly central banks, are injecting money into the economy. I think the European Central Bank alone has been injecting 60 billion euros every month into the market in what they call quantitative easing. And indeed, they are making more and more money circulate in the economy. Why are they doing that again? I think you just said it.
Yeah, in order to foster, to favor further economic development, basically.
Exactly. Yeah. Yeah. And I think the way that works is that if you have, we said that in finance, we look at the future value of money. You need to present value the flows, what they are worth today. And if you have a high interest environment, it means that the value of future expenditure is much lower than the value today. In a zero or negative interest environment, it's actually the other way. You're better off spending money today. Saving money is not attractive. Putting money on a bank account is not attractive because you're getting zero interest. Borrowing money to make an investment is cheap because the rate of interest you pay is really low. So it makes spending or investing now attractive. And that's precisely why they're doing it. They're trying to generate economic growth by making spending and investing attractive. For project finance, it's no different, I think. So it would also mean that it has a strong impetus on project finance. Governments, there's a second reason why that's true, actually, not only the interest environment, but governments like to have anti-cyclical policies. They like to invest into the economy when times are bad and downplay economic activities when times are good. So governments try to invest in an economy in bad times. And one way they do that is through infrastructure investment. So the Dutch government, someone has quite loud background noise. Could they mute? Thank you. The Dutch government has, when we had a big economic crisis in 2008 to 2010, the Dutch government made a deliberate plan to accelerate lots of its infrastructure investment. So many of our road projects, for example, that were on the shelf for conducting at a per certain point in time were accelerated, because by accelerating them, they actually created economic demand. They were able to pump money into the economy. That's another way to achieve the same response, which is a bigger economic growth. Okay.
Yep. Good.
I said in the course that when you are determining the cash flows and you're trying to draw them from your profit and loss statement, in your profit and loss statement, you would deduct depreciation And then I was saying that when you're determining the cash flows, you need to add that back. So you need to reverse the deduction. So the question is, why are we doing that? The answer to that question is that because in finance, we only look at the actual cash flows. There has to be an actual inflow or outflow of money. And depreciation is not a cash flow. Depreciation is a book entry. And it's essentially a book entry that you do to spread an investment over the productive term of the investment that you do. If you invest in a machine and the machine costs you 100, but the machine has a useful life of 10 years, rather than running in 1 year a cash outflow of 100, you try to spread the investment that you make over 10 years, 10 years times 10, because it essentially makes the cost of that investment match the productive term. And another reason you're doing this is you're saving up for the replacement of the machine after it is too old to function. You can replace it. But depreciation is a book entry and it's not a real cash flow, and therefore it can't really impact your cash flow statement and therefore your net present value and IRR calculations. And that's why you add it back if you're working from the P&L.
But Emily, I think that depreciation and amortization might have an impact on, at the end, on the book profit and so on the taxes that a company has to pay, right?
Yes, that is true. That is true. The taxes that we pay are a real cash outflow. So they would indeed be taken into account. And that's precisely why we deduct them first, then we calculate the tax, and then we add them back. Because by deducting them, we're reducing the taxable profits, which is as it should be. That is reducing the tax line. Therefore, we can make the tax line, a real cash outflow, and then we add it back.
All right, thanks.
There is a question from Pilar.
Yeah, okay, Pilar.
Yeah, thank you. I'm just trying to rephrase what you're saying. So it's more required for taxing analysis, for fiscal analysis, and for analyzing the impact on the term and compared to a term rather than on the cash flows, right?
Correct. Yeah, it's reducing your taxable profits. And by reducing your taxable profit, it's reducing your tax payment. And that tax payment is a real cash flow. So that needs to be factored into your cash flow statement. Yes. Okay. Sorry, anything else on that question? Then if there's not, then I'd like to move on to the next one. Someone was asking, I said in the course, you need to take the present value of government subsidy. What does that mean? What it means is that you need to take the value today of a cash flow that is likely to happen in the future. So probably the context of this comment would be that the subsidy does not come in today, but the subsidy comes in the future. So we have a subsidy in the Netherlands, for example, that's called the SDE, which is a subsidy for renewable energy projects. If you generate green power, say wind power or solar power, you get per megawatt hour that you generate, you get a certain subsidy. So when you've built the project, you're going to be generating power for 15 years or for 25 years, depending on the useful life of the installation, maybe even more. So in all those years, you'll be generating power, and in all those years, you'll be getting a certain extra revenue for the subsidy. If that subsidy comes in 10 years from now or 25 years from now, the value is not the same as the value is today. The difference between those values, of course, is the interest rate that is prevailing in the market, which we saw at the moment is minimal, if not negative. So at the moment, present valuation doesn't probably mean a very big discount for the value in the future. But if we were living in a high interest environment, which developing countries often are, of course, the difference between the future value of cash flows and the value today could be very different. So by present valuing a government subsidy, we're essentially trying to determine its value today, given the fact that it's going to come in the future. So in the example, let's go back to this graph again. If this were a wind turbine, a proportion of these incoming cash flows, maybe actual power, the market prices of the megawatt hours times the market price, and a proportion maybe the subsidy. So that subsidy we would need to present value, determine the present value, the value today, just as we would do with the revenues themselves. Yeah. Is that clear enough? If it is, I'd like to move on to the next question, which is making reference to the fact that we have often BOT or BOOT transactions. We build, we own, and then we transfer, or we build, we operate, we own and transfer. After a while, so we're allowed to operate the project for a certain period of time to earn money. That money should be used to earn back our investments plus or whatever funding rate we have. But at the end of that period, we would be transferring it to the government and for a very low or for a nil price. That way, the government essentially gets the asset for free at that point in time. It becomes the full owner of the asset for whatever the transfer price is, but often it's just nil. And its investment price is actually the concession fees that it's paid in the meantime. So the question here is, how is that represented in the financial model? Is this a negative residual value? Is it a loss? Is it simply closing the financial model? I think the answer is that it's essentially a sale. You sell the asset for nil. And when you sell the asset, essentially you stop. You don't get a proceeds for it. So whatever is the book value at that stage, the difference between the transfer price and the book value is a loss. So if it's been completely written down to zero and you transfer it for zero, there would be no gain or loss. And essentially the financial model just stops because you stop earning revenues and you stop incurring costs at that point in time. So it's the end, really, of the project at that stage. So when they say, in this case, the difference is that you don't sell it, I think for model and accounting purposes, it is considered a sale. It's just a sale for nil. Is that okay?
Yeah, thank you for answering this one. Just one question, and going back to what also Giuseppe mentioned on the previous question. So if you do have an accounting impact, right? So if the book pricing is negative, then you have a tax benefit
a loss
somewhere.
Yeah,
a loss.
Yeah. You may have a fiscal loss, a tax loss. It may be that you get a certain. If you have a carry-back arrangement in your taxes, you can maybe claw back that loss, and you can reduce your taxes for the previous years. If so, that would be a positive cash flows. Yeah.
Okay, great. Thank you.
You're welcome. Yeah, this is an interesting question. If we are, this is in the example that, for example, we're building a wind farm project. So we built some turbines. The turbines are generating power. and the power we sell into the market. If we simply sell it into the market, that means we pump it into the grid. The grid, there's always a demand for power, and we sell it at whatever is the market price at that point in time. Now, the big problem, of course, with wind power is that it fluctuates. And you tend to have more wind in winter, less in summer. You tend to have less wind in the evening or at night and more wind during the day. But the demand profile in the grid is not necessarily matching what the profile is that the turbines can generate. For example, most of the power is consumed in the evening when we all, or in the morning when we start up our days. We have lights and we watch TV and we shower and we're using power then, and in the evening. But there's no electricity generated. So if you look at a real-time feed-in tariff, it could be that the energy price at that point in time is very low, or maybe even negative. We've had periods in Europe in summer. In Germany, they have very substantial solar projects that on a very summery day, in the middle of the day, may be generating huge amounts of solar power. But at that stage, the demand for power may be not so high. So then you would have a negative price. So these fluctuations in the price in time of the year are obviously a risk for the financiers. So the financiers don't like the risk, so they try to lock in a fixed price. And one of the ways that you could lock this in is by agreeing with a power company that they are willing to take the power for a fixed price. But you're not selling to the power company. Technically, you're selling to the market. But the power company gives you a price guarantee. And the question is, why would they do that? So the reason from the project point of view why you would want to have that is because it gives you the insurance that there's a minimum level of revenue to cover the project financing. So that's why the project likes it. Why does the power company like it? Because they earn a fee or a premium for that. So it's like selling an insurance policy for the price of energy. Now, it may well be that the power company has another client that has a profile which is opposite to ours. We generate power, so we would want the price to go up. We don't like it to go down. Now, if we were to assume that there's also a client like British Airways, or there's a big steel mill that consumes lots of power, they would want the price to go down, not up. They fear the price going up. So their profile is exactly the opposite of us. We generate power, they consume power. So one of the ways that you could make this into an attractive deal is that the risk premium that we are likely to pay for hedging our side of the bet, that British Airways or the steel mill may be paying premiums to hedge the other side of the bet. And by connecting the two together, it may be that the go-between, the insurance company or the power company, is making a margin on both sides, and it has a natural hedge between both of those parties. And that's really energy derivatives or energy hedging. That's kind of like a bank activity, but then on energy markets. Is that a good answer to that question?
Yes.
Yeah.
Okay, thank you. Okay, the next question is a really easy one. Can I share the name of the book that we used in the course, because they have difficulty reading it on screen? I think you can download it, but then it's going to cost you a printer cartridge. if you want to buy the book, it's called Principles of Project Finance, and it's by E.R. Yescombe. I've selected this book because it gives you a nice, compressed and very complete overview of project finance. There are many more books. There are also more detailed books on the subject, but I think this one is a nice mix between being rigorous enough and not too detailed and not too long. Okay.
Yeah, Emily Giuseppe here again. I went through the chapters which I could download and try to read them, but found that there are some, I think, at least some typos into the book that are not correct.
Okay. I'm not going to take responsibility for the publisher. You mean the publishers made a number of typos in the book? I'll give them a flogging. I can't even remember who the publisher are, but I'll give them a bollocking on your behalf.
Yeah, because there are some typos that are really cumbersome, so to say.
Yeah.
For instance, the formula of the NPV calculation shows C, the cash flow in the numerator, to the power n instead with sub n, you know?
Yeah.
C to the power n makes no sense.
Yeah. Okay. I take your point. There's a new release of the book.
Maybe they corrected.
Yeah, maybe they corrected. I don't know. I don't know. Okay, the last question is the toughest question for me to answer. I think it's a really good question. I think it's a really good idea. At the moment, the course has been set up that everyone works on their own, does their own thing, and there's no cooperation model between you. There are two reasons for that. One is that I've designed this course assuming that you're all busy people and that you all have to squash this program in with your jobs, and that it's if you've got an international sprawl of people in very different time zones, very different backgrounds, it may be difficult to find a way to cooperate online and work together. But that's not for me to say. I could experiment it to see, because I do think that the old adagio of 1 + 1 is 3 works here. If you have more people working together, I'm pretty sure that the outcome would be much more than the added sum of the knowledge of the people.
We lost you.
And underfunded, and I think it would be difficult for me to find a person who could
Emil,
run
we lost you for some time, so you were muted for I think half a minute.
We can't hear you once more.
Emil, can you hear us?
I can hear. I'm
Okay.
in a place where I think the internet cut out.
Okay.
You're back now, so that's
Yeah.
good.
Am I back?
Yeah. Now we could hear you. Yeah.
Who was responding to this point?
I think, Emil, we lost you for maybe a couple of minutes.
Okay. Yeah, so I was, okay. I was explaining that I understand that a cooperation model working on these assignments together, that's a very strong feature. I'm a big believer in that. I just don't know how we can resource that at our end. And I don't know whether it relies on the people in the participants in the course being able to find each other and form a group and find a time to work on this together and a way to work on this together. I guess on a raise your hand if you think this would be a good feature to put into the course in the future.
Sorry, I did the first part of this course, the introduction to project management or something like that, which is linked to this second course to get the professional certificate in project management. And in that course, you could do a project in a team, so a team project. And I find it quite annoying, and I am glad that this course is not done that way, because no one was involved in this teamwork project, and it was a bit frustrating. You ended up doing everything on your own, and I was switching between teams to see if that wasn't the case, you know. And in every team was the same thing, like no one was cooperating, and you end up doing it on your own.
Yeah, I recognize that. We're all busy people. I guess if I did I'm not going to ask you, but if I did a show of hands, how many people are up to speed with the content of the course and have been following every week diligently? Probably no one is following it diligently every week, because we're just busy people. We need to squash it in other times. And then if you have groups of people all with their own time frames, it makes it more complicated. So I think you're confirming my fear. Yeah,
indeed, and I am halfway of the course, for your information.
Okay, congratulations. You got the best part to come still. I think I personally think the best part is that we're working with a model to try and get the Philippines case to float. It's I think you'll learn a lot from that.
And by the way, I would like to take the opportunity that more people is here, because I had an issue, like when you in these self-assessment questions that you had to do your own answer, just to write your own answer and then check with the answer that the system provides. I never been provided with the answer to the question, so the correct answer is never shown. I don't know if this is happening to other people.
I think it shows the answer once you've answered. It shows you the answer.
It does.
I don't know.
Yeah, it does.
So once you answer the question and you submit your answer, you can then click on a small button that says show correct answer on the right side of the question, and that will show a little text about that explains the right answer. So maybe you missed the small blue button once you submit your answer.
But even for those questions that you can just choose in between correct, partially correct, or incorrect.
Yeah, at least for the first weeks, I haven't tried in the last one. So yeah.
Yeah, when you have the multiple choice questions, it'll essentially highlight the question that was the right answer. So it's in a different way. You don't need to click on the show answer. It'll tell you whether your answer was correct or not correct, I think.
Okay, good to know. I will double check. Thank you, guys.
Yeah, for the open-ended question, I think that you read the question and then you write yourself the answer, and then you click show the answer on the right-hand side, and then you compare what you wrote with what is the correct answer.
And you even have an extra step that it also says show hint. where I've allocated some of the key words of the answer so that you can test whether you think you're on the right track. Yeah, in that way, I've tried to not lead you too much, but show you in a little bit towards an answer. Okay, any further questions?
Giuseppe again, excuse me, Emil. I started working with the simulation model of the power plant in the Philippines, and I found it's very interesting, very well done, very well developed spreadsheet.
Thank you.
I have a curiosity since I never worked in finance, and so I just was wondering how far away that kind of model is from something professional that you surely know.
Yeah, I would say professional models are really much bigger. Just to give you an example, in my model, I say the investment is going to cost you X million. That's just one number, where in a real model, you may have 4 or 5 different tabs for all the variant component parts, and each has their own price component. So I think they can be real beasts in terms of the volume of a model. I think this model is it gives you a nice overview.
Yes.
Without going into too much detail, but then it has more an educational value. If in a real model, everyone needs to have their element included in the model. So the building contractor will need to know exactly what he's expected to build. So that makes it, because they have so many users, it tends to be much bigger.
But the concepts are exactly the same, I mean.
The concept will be exactly the same. Another thing that I think this model does that other models don't often do, this model allows you very easy own analysis. You can change a cell because the logic is moving from the input to the output. Often in real models, because you've got things that are dependent on each other, you don't really have that logic. So you need to run scenarios, and then you need to solve again, and they can be tougher. Often the actual running of scenarios is often not done by the financier, but is done by a financial advisor who runs the model on behalf of the financier, because they can be quite complex.
All right. Thank you so much.
Yeah. And then I have a very, very quick question about the model. Actually, there's a blended rate that you mentioned, but it's not calculated. If it's in the chapters, I can look for that, and if not, could you explain very, very quickly how
I reach that?
Yeah.
Essentially, it is the proportion. It's a blended rate between various groups of funding, and in the model we're assuming 3 groups of funding. We're assuming equity, we're assuming loans, and we're assuming soft loans, which are loans at a reduced rate of interest. Essentially, the blended rate of interest is the proportion equity times the return on equity, plus the proportion of loans times the interest rate of the loans minus the tax rates, because when you pay interest, you get a deduction for the interest you pay. So essentially, you pay the net balance of the interest rate after tax, plus the proportion of soft loan times the rate on the soft loan minus the tax again. Let me see if I can find you the model and share my screen. I'll need to do some, need to look it up. Give me a second. It's downloading now. So let me share my screen with you. Can you see the model now?
Yes.
Yeah.
So the blended rate. This is the number that you're referring to.
Yes.
So as you can see, let me see if I can show you the whole thing. So it is 1 minus F32. What's F32? That's the equity proportion times the rate. This is the equity portion. This is essentially the proportion of equity times the rate that you pay for equity. This is the debt proportion, which is the equity proportion 1 minus the equity proportion times the rate that you pay on the debt, which is 38. That is 7% in this example. And then there's one F51. What's F51? Minus the corporate tax rate, because you get a tax deduction for the interest. You can reduce the rate by the deduction. So if you want to take a look, just do an F2 when you're on the WACC on that number. Just do an F2 and it'll show you how it's calculated. Does that help you, Pilar?
Yeah, thank you very much.
Okay. Okay.
I have another question.
Yeah.
So it's a very quick one. Is Microsoft Excel the most used software tool for professional finance models?
Yes. Yes.
Or maybe there's like another software tool to it. I mean,
I've not seen it. Where we work with Excel.
Okay, thanks.
And you mentioned some macros that you are going to be sharing. I don't know if they're going to be somewhere, or you were just mentioning macros in general that you can take out of internet.
Not sure. Could you repeat that question? I'm not sure I understood that question. Which macros?
I think that in the videos you mentioned that there are typical macros that you can.
Oh yeah. I can show you those. Yeah, thanks. That's for calculation. Yeah. So the IRR calculation. This is a macro, IRR, internal rate of return. And your NPV is a macro. This one is a macro. I call it a macro. It's essentially, it's just a function. It's a function in Excel. What it does, this function takes these cash flows and it calculates them to a net present value using the interest rate that we've assumed. So it takes these cash flows and it calculates them back to using a discount rate, and the discount rate it takes is the value assumption and results K6. So if we go to,
Maybe we have not seen your screen. You're not.
Okay, that doesn't help. That's not very smart. Sorry about that. So in the model, you have an IRR calculation for the rate of return. Well, what this calculation does is it takes the rates, the actual cash flows, and it calculates them back to a rate of return. So that's a function, not so much a macro, but a function, a pre-programmed function. And the NPV, essentially the NPV does the same thing. It takes these cash flows and it discounts them back at a certain interest rate, and the interest rate that it applies here, I'm telling the model to look at the assumptions and results page to K6, and K6 is the WACC. So I'm discounting here at the WACC, at the weighted average cost of capital. So these are pre-programmed functions in Excel.
Okay, but you're not using other macros.
No,
Like,
no.
Okay, additional macros. Okay.
No.
I think Adeyinka has a question. You raise your hand, and Giuseppe too.
I think they both forgot to put it down.
Okay.
Okay, I suggest we bring this session to a close. If there is one final question. If not, then I would like to suggest we bring the session to a close and go either to breakfast or sleep or dinner or wherever, whatever suits us where we are.
Thank you very much, Emil. That was very useful. That was very
Thank you.
Thank you very much, guys. Thank you. Bye.
Great pleasure.
Thank you.